Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at a few stocks to consider buying ahead of their earnings reports next week. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into the two stocks that are set to report next week after the Thanksgiving shortened week, I want to do a quick market recap to give more context of what's going on, especially with these two stocks we're talking about. So we saw mega cap technology stocks really surge to new highs recently, though that momentum has pushed the NASDAQ to new records. That includes on Friday. And we also saw the tech-heavy index touch new records once again on Monday morning, though after it hit new highs, it has then dipped. So as at around noon Eastern, the NASDAQ was down about 0.6%, with the S&P 500 up about 0.3%, and the Dow up about 0.5% as well. So with all of that, we should note that the bulls really have fought their way back in control, at least temporarily, in the face of 30-year high inflation in October, and Wall Street is still really optimistic despite rising prices and supply chain setbacks and difficulty filling millions of open jobs at the moment in the U.S. The backdrop for that positivity might focus on the fact that these rising prices have not negatively impacted the margins projections for the S&P 500 for 2022 or 2023 in any significant way yet, though we have seen a little bit of a crunch so far for some retailers in Q3 and their Q4 projections as well. On top of that, though, supporting some of this bullishness is fresh data out last week showed that U.S. retail sales jumped a seasonally adjusted 1.7% in October versus September, which is a great sign for the entire holiday shopping period, which we are now in the heart of, with those Black Friday deals already starting for many retailers over the weekend. And then obviously this upcoming weekend is a big stretch then for the final stretch for these retailers heading into the Christmas and the heart of that holiday season. So helping also support that market momentum, as is often the case, are strong earnings results and low interest rates. So in fact, the interest rates are poised to remain historically low, really, even if the Fed was forced to start raising those rates tomorrow. For the foreseeable future, the rates are going to remain really accommodating to stocks as they even are starting from that rock bottom level. So even as I said, if the Fed is forced to start to raise rates because these prices just keep rising and it's going to get out of control, it's still going to be a really accommodating interest rate environment. And despite all of these supply chain setbacks and rising prices, earnings have been strong for Q3. And looking ahead, the outlook remains positive as well. So now we're going to jump in to the first of the two stocks we're looking at today that are set to report their earnings results next week after the Thanksgiving shortened week this week. And the first one of those two stocks is Salesforce, which trades in the ticker CRM. Its Q3 fiscal 2022 financial results are due out next Tuesday, November 30th. And now we're just going to jump into Salesforce to see if it might be worth considering as a buy ahead of those earnings or around these earnings results. So Salesforce helped really start the modern software as a service industry that nearly every business, government, and countless other entities rely on to help them do just about everything in modern life, in the modern business world especially. So its various divisions help support sales, marketing, commerce, customer and client engagement, analytics, app development, and much more. So the company has grown its top line at an impressive clip since its 2004 IPO. The company posted between 25 to 30% sales growth in the trailing 5 years, so steady, improved growth, even though it went public back in 2004. So 5 years running between 25 and 30% sales growth. Its steady double-digit expansion highlights the strength of its business model and that constant need for companies of all shapes and sizes to adapt to the quickly changing tech-fueled business landscape. The pandemic-driven remote work environment also then solidified its business model, and Salesforce posted record sales last year, with revenue up about 25% to crack $20 billion for the first time. The company also raised its guidance, and it's poised to thrive in that hybrid work environment, as we said, going forward. Salesforce then also made a splash late last year when it announced its $28 billion deal to buy Slack. The company completed that purchase this past July, so July of 2021, and it's expected to help the company compete against Microsoft and Zoom and many others in the evolving work communication space. The deal comes roughly 2 years after Salesforce paid about $15 billion for data analytics platform Tableau. So all this is just to bolster its offerings, have more things they can offer their, as we said, their countless business clients in the world where maybe more and more people aren't going to be in their office every day. To have non-email based communication is going to be more crucial than ever. So that Slack deal has proved pretty vital, and the stock price has gone up since the deal went through. So Wall Street's pretty happy with it. So we should note that Zacks estimates are calling for its FY 2022, so the current year revenue, to climb 24% to $26.3 billion, with 2023 projected to jump another 21% higher, all the way up to $32 billion. The tech firm's adjusted 2022 earnings are projected to actually slip 10% from last year to about $4.40 a share, with 2023 set to then pop about 5% above our current year estimates. So the bottom line is going to be impacted, obviously, because of their growth they're going through right now, and then coming up against really tough to compare periods last year as well. But Wall Street's really looked beyond those year-over-year decline projections for Salesforce to its improving earnings estimates overall, which are up since its last report, and it currently lands as Zacks ranked number 2 buy at the moment based on those strong revisions. We should also note that the company has crushed our adjusted earnings per share estimates by an average of 68% in the trailing 4 quarters, which also includes a 63% beat last quarter. And so now if we look at the stock price, Salesforce shares have matched the computer software industry over the past 5 years, up about 300%. This has jumped about 85% in the last 2 years to lag just behind that industry. And then more recently, Salesforce shares have surged about 30% in the trailing 6 months to outclimb its peers, and it actually hit brand new highs earlier this month. The stock jumped to records amid the broader tech resurgence that sent the NASDAQ to new highs once again, as we talked about at the outset. Salesforce is still trading really at sky-high valuations in terms of forward earnings. As we just mentioned, Wall Street doesn't really care about their earnings just because they see this consistent, massive growth for a company that's getting bigger and bigger every year. So they're continuing to treat it as a growth company, as their top line is showing. And we mentioned that investors have been willing to pay up for CRM for years and years, and largely ignored its high PE ratio. Despite sitting, though, right near its records, the stock's trading about 10% below its own records, or its own year-long highs in terms of forward 12-month sales. So it's trading about 9.6 times forward 12-month sales. And it's also 20% or so below its high watermark in terms of forward earnings. The stock has slipped about 4% from its earlier November records. It was down about 1% Monday morning, the last time I checked, at around $298 a share. This has helped it fall from overbought RSI levels of around 81, so well above that 70 or higher threshold a few weeks back, to near neutral at around 50 at the moment. So that's a pretty positive sign that there could be some ability for it to climb if it's able to impress investors next week. And this is even more contrasting compared to the likes of Apple and Microsoft and many others that have helped the NASDAQ once again hit new highs. Both Apple and Microsoft hit new highs Monday morning, and the NASDAQ 100 tracking QQQ ETF is once again above overbought RSI levels at 73. So this divergence between some big, huge tech names and Salesforce could be a positive sign heading into its earnings release next week. And obviously, longer-term investors don't need to be necessarily nervous about buying stocks even within 5% of their highs, since timing the market is extremely difficult. And if you were worried about buying Salesforce at its highs, say 5 years ago, then when were you going to buy it? So we should also note that Wall Street is really bullish on Salesforce, with 23 of the 27 brokerage recommendations that Zacks currently has coming in at strong buys, and none of the recommendations come in below a hold at the moment, which is really impressive as well. So let's also remember that Salesforce offerings are not going out of style anytime soon, and its customers largely become dependent on its constantly expanding portfolio of business software. So there's really no turning back. There's no, I mean, you could get a different CRM company, a different customer relationship management company, and different business software. But once you're paying for these software as a services every month, your workforce gets reliant on it, your business gets reliant on it, your customers get reliant on it. So that's why Salesforce has been such a hit on Wall Street and why investors are willing to pay up in terms of its forward earnings. So therefore, you might want to consider it as a stock worth buying for not only the rest of 2021, but for the long term heading into its Q3 results next week. And now we're going to go on to a totally different stock that also reports its Q3 results next Wednesday, actually December 1st, and that is Five Below. And that trades with the ticker FIVE, so 5. And as I said, it's a completely different company. It's a off-price or low-price retailer. So the company sells what it calls trend-right high-quality products loved by tweens, teens, and beyond. If you've ever been into one, I've actually gone into one to buy some Christmas gifts to donate to Toys for Tots. It's a great place, lots of toys, great place for, as they said, tweens, teens, and beyond. So they sell a range of products between $1 to $5, though most can cost more, or some can cost more. It's worth noting that. But most are between $1 to $5 in categories such as sports and tech and books and candy, really anything else young kids might want, especially for the holidays. It's a great place. The company operates over 1,100 stores at the moment across nearly 40 states. And the discount retailer doesn't necessarily compete against Dollar General, since its offerings are more non-essential goods geared towards younger customers. So it does have a really nice niche within the broader retail space and even this broader low-cost discount retailer. And like all successful retailers, it has improved its e-commerce offerings, and it's currently offering same-day delivery options. It announced in the late June that it expanded its Instacart partnership nationally, so that's a positive sign for those concerned about some companies like these maybe sort of neglecting their e-commerce opportunities out there, but they have gone headfirst into that. The company also continues to open new locations at an impressive clip, and Five Below's revenue has climbed by between 20 and 30% for the last 7 years, having posted even larger growth before that. Five did obviously take a hit during COVID, but it was able to bounce back in the second half of last year, and it was able to post about 6% sales growth last year. So that was its worst year in a long time, hit by COVID. Five then topped their Q1 estimates in June, and its Q2 results were pretty impressive as well. So its net sales were up 52% from the second quarter, and we should note that its comparable sales were up 39% versus the year before. And the company also opened 34 new stores during the quarter to end with 1,121 to be exact. So as I said, over about 1,100 stores. This was up about 14% from the second quarter of 2020. So looking ahead, our estimates are calling for its revenue to climb 43% this year to $2.81 billion, with 2022 projected to jump another 17% higher, which would come in nicely compared to some recent results and continue its impressive run of double-digit top-line growth. Meanwhile, its adjusted earnings are expected to climb 125% this year and then another 15% in 2022. We should note that the company's seen some mixed earnings estimate revisions activity, but overall, both its 2022 and 2023 consensus estimates are up a few cents compared to where they were before its last release in Q2. So overall, some positivity, and we should note that it's consistently beat its bottom line. It had some big beats in the last year, but its most recent beat was 4%. The beat before that was 33%. The beat before that was 4%, and the beat before that was 90%. So some variability in these massive beats, but it has in the last year had some huge beats of 33% and 89%, but also it's beat in all 4 of those quarters as well. So overall, the company lands a Zacks rank number 3 hold at the moment. As I said, given some of that variability in their earnings revisions with some up and some down, but overall the consensus estimates are higher. Meanwhile, 9 of the 15 brokerage recommendations that Zacks has are strong buys with nothing below a hold, so some positivity there. We should note that the stock is up about 40% in the last year to just outpace the market. in about 400% in the last 5 years to easily top the market. And its industry at around $216 a share. It's trading about 4% below its records recently, and it's gone on a big run along with the market off those when it reached some overdone technical levels at the beginning of October. And we should note that a little bit of a pullback has put it back below overbought RSI level. So it's at 62 at the moment, which is a good sign heading into its upcoming release that it might have some room to run if it's able to impress investors. Overall, the stock is also trading at a discount to its year-long median in terms of forward 12-month earnings. It's trading at about 40 times forward 12-month earnings. So that's a solid sign that even though the stock's trading not too far off its records, it's trading at a discount to its own year-long medians. So therefore, investors with longer-term horizons might want to consider this discount retailer that continues to expand within an area of the retail space that the likes of Target and Amazon and Walmart clearly aren't addressing, because the company's been able to post really impressive growth while continuing to open more and more and more stores. So obviously Salesforce and Five Below could not be more different companies, but they're both reporting their Q3 results next week, and they both could be worth considering as not only near-term plays for the rest of 2021 and heading into 2022, but as just possible longer-term additions to a solid, diversified portfolio. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.